This show is part of One Place, a daily network of focused briefings across the stories people follow most.
Welcome to the Roundup. We are diving into a packed Tuesday with updates on global markets, major tech litigation, and the shifting landscape of artificial intelligence. Let's get right into the headlines.
European markets rise despite ongoing Middle East conflict tensions.
UK inflation holds steady but faces future energy spikes.
Epstein's associates explain their massive $75 million bequests.
Meta tells specific divisions to work remotely amid layoffs.
A jury orders Meta to pay millions for child exploitation.
Anthropic fights the Pentagon over a military technology ban.
Mike Lynch's estate loses a major appeal against Hewlett-Packard.
The Lynch estate faces potential bankruptcy after a $1 billion ruling.
CoreWeave CEO credits nerdiness for $43 billion pivot.
A new benchmark tests if AI can detect total nonsense.
First, the global economy. European stock markets are showing some resilience today, following strong gains in Asia. The FTSE 100 in London climbed by 1%, while indices in Germany, Italy, and France saw even larger jumps. This rally comes at a strange time, as gold prices have actually dropped 13% since the Iran conflict began in late February. Usually, gold is a safe haven, but its recent volatility is raising questions. Meanwhile, oil prices dipped over 6% this morning on hopes for a ceasefire following a 15-point peace plan sent by Donald Trump to Tehran.
The UK is taking a proactive stance by offering to host an international security summit. The goal is to create a collective plan to reopen the Strait of Hormuz, a vital shipping lane for 20% of the world's oil. Chancellor Rachel Reeves emphasized that the government is focused on a responsive economic plan to support working people during this uncertainty. This includes measures like taking £150 off energy bills. However, she has ruled out universal support, insisting that any future government help must be targeted and fiscally responsible to avoid past mistakes.
Next, UK inflation data. UK inflation held steady at 3% for February, which was the lowest level since early last year. While that sounds like good news, economists are warning that the war in Iran is likely to send prices spiraling again. Oil has already jumped from $70 a barrel to nearly $100 since the conflict started. This surge hasn't fully hit the consumer data yet, but it's expected to drive up energy bills, transport, and production costs very soon. Investors are already pricing in the possibility of multiple interest rate hikes later this year to combat this looming pressure.
The Institute of Grocery Distribution is particularly concerned about food inflation, which could surpass 8% by June if energy market disruptions persist. We are seeing a bit of a lag in the data. For instance, clothing and footwear costs hit a one-year high in February, while food price growth actually slowed down slightly. However, analysts point out that February's data might feel redundant because pump prices have already started surging in March. The Bank of England had hoped to hit a 2% inflation target by spring, but that goal now looks increasingly difficult to achieve.
Now to the Epstein estate. New details have emerged regarding the management of Jeffrey Epstein's $630 million estate. His longtime attorney Darren Indyke and accountant Richard Kahn recently testified before the House Oversight Committee. They explained that they have been working as co-executors without taking a salary since Epstein's death in 2019. This lack of pay is why they believe Epstein left them massive bequests of $50 million and $25 million, respectively. They've spent years selling off his mansions and private islands while settling claims with victims, describing the work as a massive legal and financial headache that could take another decade.
Despite these huge bequests, Indyke and Kahn might never actually see that money. The funds are tied up in a pour-over trust that only receives assets after all other estate balances and lawsuits are settled. Currently, the estate has about $127 million in liquid assets, but it faces numerous pending lawsuits from victims. Just recently, they settled a class action suit for $35 million. With more claims expected and investments still needing to be liquidated, the path to receiving their millions is complicated by the very legal mess they are tasked with cleaning up.
Moving to Meta's layoffs. Meta employees in the wearables and ads divisions were told to work remotely this Wednesday, a move that often signals impending layoffs. This comes as the company prepares for a significant workforce reduction that could affect up to 20% of its 79,000 staff. That would mean roughly 16,000 people losing their jobs. It is a stark contrast to the news that Meta also detailed a massive stock-based compensation plan for its senior executives. While the company is cutting costs in some areas, it is doubling down on investments in AI and senior leadership to drive future growth.
The wearables unit is particularly interesting because it includes AI glasses and augmented reality, which Meta previously identified as key investment areas for 2026. However, the company has been shifting its strategy away from the broader metaverse concept, having already laid off a large portion of its Reality Labs group earlier this year. The stock has been struggling, down nearly 3% over the last year, as investors weigh these heavy AI investments against the massive cost-cutting measures. This remote work directive has left many employees on edge, waiting for official word on who will be staying and who will be going.
Next, Meta's legal defeat. In a historic ruling, a New Mexico jury has ordered Meta to pay $375 million in civil penalties. The jury found that the company misled consumers about platform safety and enabled child sexual exploitation. This is the first time a bench trial has found Meta liable for acts committed by third parties on its platforms. The New Mexico Attorney General, Raul Torres, called the verdict a victory for families, stating that Meta executives chose profits over the safety of children. The lawsuit was sparked by investigations showing how Facebook and Instagram had essentially become marketplaces for illegal trafficking.
Meta has already announced plans to appeal, calling the arguments sensationalist and claiming they cherry-picked documents. The company maintains that it works hard to identify and remove bad actors. However, internal documents presented during the trial suggested that employees and experts had repeatedly warned leadership about these risks. The jury was also shown evidence from a sting operation called Operation Metafile, which led to the arrest of men preying on children through Meta's tools. The court even heard concerns about Meta's decision to encrypt Messenger, which critics argue makes it much harder for law enforcement to track and stop these predators.
Now, Anthropic versus Pentagon. The AI startup Anthropic is facing off against the Department of Defense in federal court. Anthropic is seeking to pause a government ban that prevents the military and its contractors from using its Claude AI technology. The conflict stems from Anthropic's refusal to allow its tools to be used for domestic mass surveillance or fully autonomous lethal weapons. In response, the Secretary of Defense labeled the company a supply chain risk. Anthropic argues this designation is punitive and could cost them hundreds of millions in revenue. The judge noted that the government's actions seem like an attempt to cripple the company.
This legal battle has huge implications because the U.S. government has actually relied heavily on Claude for various operations over the past year. The government's lawyers argued that the secretary's social media posts about the ban weren't technically legal actions, but the judge seemed skeptical, given the clear directive issued to contractors. This standoff is creating significant tension between Silicon Valley and the current administration. It highlights a growing divide over the ethical boundaries of AI in warfare. If the injunction is granted, it could temporarily restore Anthropic's status, but the long-term relationship between tech firms and the military remains very fragile.
Next, the Lynch ruling. The estate of the late British tech tycoon Mike Lynch has been ordered to pay nearly £1 billion to Hewlett-Packard. A High Court judge refused the estate's request to appeal a previous ruling that found Lynch liable for fraud during the 2011 sale of his company, Autonomy. HP has long claimed that Lynch deliberately inflated Autonomy's revenues, leading to a massive multi-billion-dollar write-down shortly after the acquisition. While the judge acknowledged that HP's original damages claim was likely exaggerated, he still ruled that the losses suffered by Hewlett-Packard Enterprise were substantial, totaling around £700 million before interest and costs.
This legal saga has been one of the UK's largest civil fraud cases spanning over a decade. The recent ruling adds significant interest to the base damages, bringing the total owed to roughly $1.24 billion. Although the estate was denied permission to appeal by this specific judge, they can still apply directly to the Court of Appeal for a second chance. HP has welcomed the decision, stating it brings them closer to resolving the long-standing dispute. However, for the Lynch family, this is a major blow as they continue to defend the reputation of the entrepreneur who passed away just last year.
Continuing with Lynch's estate, the financial pressure on Mike Lynch's estate is now reaching a breaking point. With the court ordering a payment of £920 million, the estate faces potential bankruptcy. Estimates place the total value of Lynch's assets at around £500 million, which is less than half of what the court has awarded to Hewlett-Packard. This ruling comes just 2 years after Lynch died in a tragic superyacht disaster, shortly after being acquitted of related fraud charges in the U.S. His family remains disappointed, arguing that the damages are vastly exaggerated and that the truth was exposed during his successful U.S. trial.
The Lynch family spokesperson emphasized that the damage to autonomy was a result of HP's own failures rather than any wrongdoing by Lynch. They believe an application to the Court of Appeal is necessary in the interests of justice. It is a complex situation where the UK Civil Court and the US Criminal Court reached very different conclusions about the same events. While the US jury saw no crime, the UK judge found that the firm's financial position was not accurately portrayed. Now, the estate must navigate a massive financial shortfall that could wipe out the legacy Lynch spent his entire career building.
Now to CoreWeave's success. CoreWeave has transformed from a small crypto mining firm into a $43 billion AI powerhouse. CEO Michael Intrater credits this success to the company's nerdy roots. By deeply understanding how to manage GPUs during the crypto era, they were perfectly positioned when the AI boom hit. They didn't just see computing power as a tool for mining Ethereum, they saw it as flexible infrastructure. When the crypto market crashed in 2018, they didn't fold. Instead, they immediately began looking for other use cases, eventually becoming a primary provider of GPU capacity for major AI companies and cloud giants like Microsoft.
Not everyone is sold on their model, though. Some short sellers argue that CoreWeave is just a debt-fueled rental business without a real competitive moat. They point out that the company relies heavily on massive loans to buy the expensive NVIDIA chips they then rent out. Intrater defends their strategy, describing it as an innovative financing structure he calls the box. This system bundles customer contracts and hardware into a vehicle that ensures cash flow covers debt and operations before turning a profit. Despite the skepticism, their rapid scaling and massive valuation suggest that their early bet on specialized AI hardware is paying off.
Finally, testing AI nonsense. A new benchmark called Bullshit Bench is putting AI models to the ultimate test. Can they spot total nonsense? Created by Peter Gostev, the test uses deliberately absurd questions that sound technical but are actually meaningless. For example, one question asks about the viscosity of a deal pipeline, and when the flow becomes turbulent. A human would immediately see the joke, but many AI models try to give a serious, calculated answer. This highlights a major flaw in current AI. They are often programmed to be helpful and agreeable, which leads them to confidently hallucinate answers to questions that shouldn't be answered at all.
The results so far are quite telling. Google's Gemini 3.0 reportedly struggled, failing to reject the nonsense more than half the time. The benchmark includes ridiculous prompts from finance, law, and medicine, like asking how the font weight of an invoice affects quarterly earnings. The only correct response is to refuse to engage, yet many models plow ahead with complex formulas. Interestingly, one AI company performed significantly better than the rest, though the researchers are still analyzing why. It serves as a humorous but necessary reminder that while AI is getting smarter, it still lacks the basic common sense to call out pure BS.
That's the roundup for today. Thank you for joining us for this briefing. We'll be back tomorrow with more updates on the stories you follow most. Have a great day.